If you have a big down close candle or a bearish candle, the opportunities that exist at the midpoint of that candle and to the low, that's your sweet spot. Okay, what do I mean by that? If the market's going lower, okay, many times you'll see how, like it does here and like it does on this candle here, where we have a down close candle. If we're bearish, the next candle here, it trades up into the previous day's candle, but working specifically at the 50% of the candle and to the low. So the next continuation is going to occur there. Over here, same thing, looking at the bodies, we have a down close candle. Next one here, we trade up into, and we even cross through into the volume imbalance right there. Does it completely close it in? No. Next candle here, it closes down. So we used 50% of the candle into the low. So the next sell scenario for the next trading day is here. It's going to occur within the range between the 50% or the low of that previous down close candle. So why is that important? We have a down close candle, split it in half. From that range right here, I'm rough eyeballing it, okay, from this level here down to the low. So the next candle, if it opens, it can trade up, not to the 50% and higher. That's not an ideal scenario, but we want to see the sell scenario that would lead to lower prices form between the midpoint of the candle to the low. Okay, so in other words, what's happening is the algorithm knows the previous day's range, and it divides it in half. And that low on this candle to that midpoint of that candle, that's the operating range that the macro will work within. And what do I mean by that? The delivery will start on this candle's open and trade up into the range of half to the low of the previous candle, because so that's where your setup's going to be. Right away, you have a huge advantage right there. When we drop down to the lower time frames, I'm going to go right into a 15-minute time frame, and you'll see that this candle's low is the lower of the blue line. And then this candle here, right here, that will be in a bearish order block that everybody's familiar with. Okay, so let's do that. Let's drop down. Remember all these levels here in this little green line here, that's the 80 level, 91.80. All right, so here's the 15-minute time frame. We're focusing on the 31st of August, and the 5-minute fractal that I was showing is all of this. Okay, all of this right here is a market maker sell model. So from here to here, down to here, that is a 5-minute ICT market maker sell model. We had price trading on the 31st. It starts right away higher, and it trades up into that first lower level, low, which is over here. That's that previous low, and in that higher blue line, I told you that would be a 15-minute bearish order block. Relative equal highs. So it's trading back up into that low here, and then stretching beyond, because it has to get above these levels here to take out that liquidity. What liquidity rests above that? Buy side liquidity. What does that mean? Buy stops. Anyone that's going short, that's trailed their stop loss, they feel comfortable with placing their buy stop here. As prices broke down, they think that this is where the logical level would be to put their protective stop loss. Last up close candle in this price swing, that opening price, okay, you're going to look at this figure right here. The opening price on that candle is 92.48. Price trades right up into that. What's the high of this candle? 92.48. It's absolutely to the pip. You cannot get any better than that. Trades up to that level and then starts to break down. That candle is your smart money reversal. Now you have to look for your low risk sell. Where does that occur? Well, as you see price going up, this is the curve. But every movement of price where it's down, in other words, the down close candles prior to the smart money reversal, where the curve changes from buy side to sell side, all the down close candles match that up with a move on the right side of the highest candle here. In other words, at the smart money reversal of the market maker sell model, to the right of this candle, everything that's a short has to match up with what was a down close candle on this side. So if I'm bearish, I'm looking for this pattern, okay? Wherever the original consolidation is, I'm selling with that in mind, and then I'll leave something on to capture any runners that would hopefully develop. So if you're looking for this pattern or fractal to form in a bearish environment, you have a real likelihood to catch a runner because you're just getting in sync with the move, which is the algorithmic repricing to this fair value gap. And it went below the 92 figure, and here's the 80 level, okay, 91.80. Look at the respect it's having in that level, and then it repriced higher. At the time, we have this area right here, okay? All this displacement on the downside, it trades down to the top end of that old fair value gap that I showed you on the daily chart that the market was going to reach down to since June 10th. Look at this down close candle right there. What's the low of that candle? 92.30. What's the high of this candle? 92.30. It's absolutely perfect. This area that was a buying point prior to it makes this high. When it starts to break down, any buying point has to be mitigated. So this becomes a mitigation block. Ooh, the plot thickens. All right, so here's the 5-minute chart, and you can see very specific levels here. This down closed candle prior to this run up, extend that out in time, hits it 2 times and then breaks lower. Here's that down closed candle here. It hits it, trades down. It's attacking the original consolidation over here. But that's not all there is to the move. You have to submit to what it's likely to reach down to, which was, this was the top of that fair value gap, but it can drop lower. So if we get another selling opportunity, what would that look like? Well, we have buy side liquidity resting above these highs and bearish order block that's inside. In other words, this last up close candle overlaps with this mitigation block, and then you get this. Isn't that an optimal trade entry? Sure it is. Here's your 70.5, that's your sweet spot. Bam, hello, thank you, ma'am. And then starts to break lower.